Alrighty, we are ready to get started here today. How is everybody doing out there? Hope you are doing well. My name is Andrew Kuhn. Thank you so much for joining in with the Focus Compounding Podcast. I would, at this point, usually say, Mr. Geoff Gannon, how are you doing today? But Geoff actually isn't joining us here today. He will be in the next episode. We decided whenever we bring on individuals, since Geoff usually only gets about one or two sentences in because I have a loud and a big mouth and I keep talking, we decided that I'm just going to be the one to interview the individuals that come on. So for today, we have a very special guest and someone that I've been trying to get on for a couple months now, and I've been telling Geoff for a couple months how excited I am to have him on. His name is Cassel, and if you don't know him, you definitely should. He is at Cassel on Twitter. I call him the Dalai Lama of FinTwit, and I mean that in the nicest way possible, because not only does he give out great advice when it comes to investing, but he also gives out great wisdom and advice when it comes to life in general. So he is a great follow on Twitter. That's at Cassel. That's IanCassel. Ian, how are you doing here today?
I'm doing fantastic, and I want to thank you and Geoff, even though he can't be on here, for inviting me on. I'm honored to be on here. I've been a big fan of the work that you guys are doing, and I've been a fan of Geoff's for many years. So thanks for having me on.
Yeah. Do you like my my nickname I gave you, the Dalai Lama of FinTwit?
I do.
I thought, yeah, I told Geoff that we were talking. I'm like, he really is. He gives some really great advice on investing and on life. So if you're not following him, you definitely should be. So Ian, I think you said you listen to the podcast regularly, and it may become redundant, but I always talk about how I'm sort of fascinated with this idea of stories. And one of the most rewarding thing for me, and Geoff, I know as well, talking with individuals has been learning about other people's stories. And, you know, the narrative is always being written, and something can happen in your life that may seem like a letdown at first, but then it actually turns out to be this incredible journey that, you know, it puts you on. And I'm always just fascinated to learn about everyone's story. And today we're going to be talking about your story, how you got into investing, and sort of what you're doing now. So maybe you could just sort of give us a background on you and how you got into investing, and I guess pretty much how you got to be where you are here today.
Sure, I'd be happy to do that. I'm 37 years old. I live in Lancaster, Pennsylvania. And you and I were talking before we got started this morning. Lancaster, Pennsylvania is known for its Amish tourism and Amish community. You know, the second thing that people probably aren't aware of is that Lancaster County, Pennsylvania, just got ranked #1 as the best place to retire in the United States, which surprises a lot of people. It surprises me, even though I live here. But it's actually a phenomenal place to live, and always been in this area. I've grown up in the Lancaster County, Lancaster, Pennsylvania area. Went to school here, and really my investment journey started, I would say you have to go back to maybe 1997, and I would have been around 16 years old at the time. And my parents sat me down and they told me that they had saved for me approximately $25,000 for my college education. And they sat me down when I was basically a junior in high school, and they told me how much I was going to have, because, you know, that was all I was going to get. And they wanted me to make the proper decision and where I wanted to apply and go to college. You know, it was up to me if I wanted to go to a local university that might be less expensive, or go to a private university, which obviously that $25,000 would last about one semester. And at the same time, you know, this was 1997. This was the height of the internet bubble, or at least leading into the height of it. And I was getting more and more interested in investing. I started talking to my parents' financial advisor, and he introduced me to a few small cap technology companies. And really, you know, I made a decision then that I was going to go to a local university, which was more inexpensive, and I was going to work almost full time for actually a financial advisor, more or less being a glorified secretary, and I could work and pay for my college as I went, so that I could then invest that capital into the market and not worry about having to spend that on college tuition. And so that's exactly what I did, and I invested in a couple small cap technology companies and grew that $25,000 up to about $100,000 by around the peak of the bubble. And really, when that bubble started to break and everything started to drop, I did sort of the worst thing, which was continue to average down into these same two small cap technology companies. I remember buying them at 40, buying them at 20, buying them at 5, buying them at 2. And, I quickly lost about 95% of the money from its peak. And, that's a very jarring experience. It's a very emotional experience. It's a negative experience, but it's also a great learning experience. And similarly, around that same time period, I was looking at small companies, smaller and smaller companies, known as microcap companies. And when I was looking at these microcap companies, one of the first ones I looked at was a microcap company called XM Satellite Radio. And XM Satellite Radio, a lot of us know it today as Sirius XM today. And as we all know, you pretty much every new vehicle that you purchase is fully equipped with a Sirius XM radio. But back in 2001, 2002, it was just a story. And, XM Satellite Radio at the time was just a story. I mean, they had, I think it was around 170 million market cap MicroCap, which was a larger MicroCap. They were, had about $1.5 billion in debt from launching these satellites up into space. They had very few customers. They had no OEM agreements with any of the major car manufacturers at that time. And in fact, it was really a coin flip whether that company was going to survive. Around 41 or 42% of the shares were held short at that point in time. And so I kind of give you that backdrop to tell you that, you started off this podcast by saying you like stories, where I evidently love that story too, because I definitely didn't like it because of the fundamentals of the business. And so I started diving into it, doing a little bit of due diligence, which was very rudimentary at the time, just looking through a couple of their filings, reading through press releases and things like that. And, I was drawn to that story because back in 2001, 2002, I mean, everybody had a terrestrial radio in their vehicle or in their home. And, you got 10, 20, 50 miles outside your locality, you quickly lost reception. You were forced to find a new channel on the radio, and it was just a pain. And so the idea of having 100 crystal clear channels streamed to your car that you could access anywhere in North America was just an appealing story. And so that's what drew me into it. I started diving into it. I saw that the CEO, Hugh Panero, was going to be presenting at a conference in New York City. And I called the conference organizer and I told him I was Ian Cassel with Cassel Capital, which I completely made up.
Nice.
and they let me come. And it was only actually a couple months later that I realized there was a Cassel Capital that was in New York City, and they probably thought I was the founder's son or something like that, which was funny. But they let me come to the event, and then I had to worry about, well, what am I going to wear? I was never to New York City before,
Sure.
And the only suit I had was the suit I wore at my senior high school photos, and did I still fit into that thing? I was a sophomore in college at this time, and putting on the freshman or sophomore 15 from some beer and things like that. But luckily I fit into the suit. I got some fake business cards made. And at 5 a.m. One fine morning, I got on a bus from Lancaster, Pennsylvania to New York City and had printed out the 10K of the company and read that on the 3-hour bus ride up, and ended up going to this event, kind of getting checked into it. And, as I was looking around the conference area, I noticed all of these kind of one-on-one rooms that were down the hall, and where these management teams were having one-on-one meetings with institutions. And I'd asked if I could have a one-on-one meeting with Hugh Panero from XM Satellite Radio, and they said no, his day was completely booked full. And so I just ended up going to the main presentation hall, kind of sitting, listening to a few presentations, waiting for Hugh to give his main presentation. And when he did, I listened attentively, but I was really looking to kind of follow him out the back of the room, which is what I did after he was done. Followed him into one of those one-on-one meeting rooms, which he was early to getting to, and just asking if he had 10 minutes before his first official meeting started to spend some time with me talking about the business. And I ended up talking to Hugh for about 10 minutes. And, it was just simple questions I asked, and, there was nothing special, but, really it was that 10 minutes I spent with him. I came out of that meeting just energized, probably infatuated is the correct word. And, got back on the bus, went home, couldn't sleep at all that night, and took that, $4,000 or $5,000 I had left and bought XM Satellite Radio the next morning at $1.78 per share. And, almost immediately the business started executing. They signed their, first or second OEM agreement. They refinanced their debt. And what ultimately ended up occurring was one of the biggest short covering rallies in stock market history. The stock would go from around $1.78 per share to $34 per share in about 14 months.
Wow.
And, I ended up making back all the money I lost in the dot-com bubble and then some. And obviously, I look back on this story, and I think everybody that's listening to this podcast today can agree that's 150% luck. I was at the right place at the right time with the right amount of stupidity and the right amount of courage at the same. And I placed that bet, and I really point to that story as well as sort of the beginnings of my infatuation with microcap equities. And really what drew me in was the ability to sit down and talk to management teams. That really nobody like me could sit down and talk to the CEO of a microcap company. And that's kind of what started my love affair with kind of more of the qualitative art of investing. And so that's really my story that got me started. And then from there, I just started investing in microcaps. And back at mid 2000s, early 2000s, a lot of the discussion on microcap equities was mainly on public message boards like Raging Bull, Yahoo Finance, Investors Hub. And so, I was very active on those communities, found a lot of people that were kind of like-minded with my philosophy, found a couple mentors actually on those message boards as well, and just kind of continued to learn the art of investing and learn how to invest in microcaps, and learned by losing my money over and over again. And then you start losing less money, and then you start making a little bit of money, and that's really how I taught myself through those years. And went right from undergrad, which I went here locally at Millersville University, went right from undergrad into graduate school, got my MBA from Villanova University, and then so that was in 2005. 2005, I didn't have enough capital to kind of do this full time as a private investor, and so I worked for a consulting company in New Jersey for 6 months that dealt specifically with consulting with small microcap companies. After a few months, I realized I could do what they were doing on my own, so I started my own advising business. Did that for about 3 years. Advised some companies to really kind of give me more time to build my own capital. And then finally in 2008, more or less said, as the market was crumbling, made the decision to stop advising and just invest full time and become a full-time private microcap investor. And so,
and what were you doing when you were advising these companies?
It was mainly just advising them on, you would probably call it investor relations, but a lot of these companies I found just didn't know how to communicate with the marketplace, and they just, they knew how to run their businesses, but they didn't know how to communicate their story at all to even, in a written press release or anything like that. And so I just helped them with those types of things, and really kind of only sought out companies that I thought had significant promise, and so, that's mainly what I did. I had about 7-8 clients over the course of 3 years.
Wow.
And the main goal was to get out of that as soon as I could.
Yeah, sure. No, that's so funny because you've been in the microcap space pretty much then your whole career.
I have.
That's interesting. So you advised them for a couple years, and so then you became a private investor. How old were you when you became a private investor?
27.
Wow. Yeah, and I thought I have that written down on my notes. I said in my notes it says he retired at 27 ? Because I thought I remember that you said in one of your blog posts that your dad always says you retired at 27 or something along those lines.
Yeah. I always, that was obviously tongue in cheek, but yeah, everybody says I retired, but it certainly is not retirement. That's for sure. Imagine your own capital.
That is so funny.
Yourself from it.
That is so funny. So what do you think that drew you to microcaps in the first place? Was it that you just sort of stumbled upon XM radio that because it was cheap and you didn't have a huge sum of capital, so it just was sort of appealing to you in there and it worked out and sort of just set you on this journey? Or what do you think drew you to microcaps?
I honestly think what drew me to microcaps was two things. Number one, I was really drawn in by the ability to access management. That I could pick up the phone and talk to a management team and supposedly get an edge. I call it supposedly because sometimes sometimes it's an edge and sometimes it's not. But I think that's what drew me in, and also the idea that there were so many companies that were microcap companies. I mean, it's more or less about half the public marketplace or half the market ecosystem is microcaps, defined as market caps under 300 million. And so, these are obviously undiscovered for the most part companies. And, really I paid closest attention to those microcaps that are in the smallest half of the microcap ecosystem. And so that's and that hasn't changed since then. So I'm primarily looking at companies south of 100 million market cap, because this is an area that really doesn't have any type of. There are some institutions that invest down into the weeds, down in sub 100 million, but there's not many. And this is one of the last areas that you can gain an edge in investing, and it's one of those edges that's been in place for probably decades. And that's really the fact that larger, smarter money can't invest down in this small realm, because as you can imagine, as I'm sure you've talked about, maybe had other guests on, it doesn't make any sense for a manager that's managing 200, 300 million, let alone 2 or 3 billion, to pay attention to an equity that trades $5,000 worth of stock a day. And so that's where, if you're a smart, intelligent investor that is talented, you can really get an edge in some of these smaller equities, because these larger, smarter folks can't invest down in here. And in fact, probably the other side of that, which makes it even better, is they can invest, but these equities have to be higher and more liquid for them to invest. And so ultimately you have these waves of capital that come into an equity as a management performs, as a company executes, as it's fundamentally driven higher. You have these larger and larger waves of capital that come in, because all of these institutions that couldn't buy it at 1 when it was trading $20,000 worth a day can buy it at 5 when it's trading $500,000 worth of stock a day. And so it's really fascinating to kind of see the maturation of an equity as a management executes.
Yeah, and I guess when it comes to liquidity in the microcap space, there's a lot of people that sort of get turned off by lack of liquidity. Geoff and I always talk about how we actually like that, and there's been numerous studies done that have shown that, especially in the microcap space, that illiquid microcaps have performed somewhere in the neighborhood of 18 to 19% over the past, 20 to 30 years. But if you look at liquid microcaps, it's actually like break even to like -1 or -2. So it's sort of interesting how that works out. Do you look for more illiquid microcaps? I know you've written about before how you like to buy them when they're illiquid, and then the beauty of it is selling them when they become more liquid and when the market starts to realize them. But do you specifically look for illiquid microcaps?
Yes, mainly. If I were to sum up my investment strategy in one sentence, which, believe it or not, I try to do, and I try to refine that sentence every year. And it's funny how much that sentence has changed even over the last 7 years since I've been doing it. It's probably why I like Twitter so much, because I like kind of refining broad things down to something that's very short.
Sure, yeah.
But if I were going to define my investment strategy into one sentence, it would be this. It would be, my goal is to own the smallest, most illiquid, least institutionally owned, misunderstood businesses that I can find that are run by intelligent fanatics. And I realize that sentence is a little bit of a mouthful, but I think we've probably already hit on some of the areas of why microcap investing is interesting, and part of that is really just due to the fact that these are small companies, and believe it or not, the smallest decile of the public markets. So that would be defined as the smallest decile historically is sub 114 million market cap. So that smallest decile has outperformed all the other market cap classes when you look at from 1927 to 2016. So that smallest market decile hasn't just beat it, it trounced those other market cap deciles. When you look at it, that decile has averaged about 17.5% compounded since 1926. And for example, when you compare it to the second decile, the average return is around 12.5.
Sure.
So 17.5 to 12.5.
That's crazy.
So I pay attention to that smallest decile. That's my stomping ground. And when you think about 114 million market cap, there's a lot of equities that fall under that threshold. There's probably about 8,500 stocks in North America alone that are in that smallest decile. That's more companies than that trade on the New York Stock Exchange and the NASDAQ combined. So there's a big area to look at to invest. And second thing, which is what you hit on, was, and part of that sentence that I gave you was, I want to find illiquid equities. And I think one of the studies that you're referring to is one done by Roger Ibbotson, who's a Yale finance professor.
Yep, that's
He's
it.
Also kind of the chairman and CIO of Zebra Capital. He's written several white papers, and the one you're referring to, which is titled Liquidity as an Investment Style.
You got it.
And he argues that liquidity should be given equal standing to size, value, growth, momentum, and I think a couple other investment styles. And he argues, through his empirical evidence, which I believe he's looking at equities from 1971 to 2017, and he updates this white paper every single year, which is nice. But the main kind of conclusion of this white paper is an interesting one, which is liquidity dominates size as a return predictor. So, and you mentioned some of them. So in his latest white paper, when you look at illiquid microcaps going back from 1971 to basically today, illiquid microcaps have produced around 16 and change percent returns. Liquid microcaps, so illiquid 16%, liquid microcaps is around break even. I think it's 0.1% compounded. And so when you look back, and he does it by all market caps. So when you look at large cap, for example, illiquid large caps, because there are such things as illiquid large caps. I think that they produce around 11% returns historically since 1971 compared to liquid large caps, which is 9%. But that difference between that is striking in the microcap arena. And so I definitely pay attention to the illiquid small microcap companies, and I think there's plenty of empirical evidence that shows that this is the place to invest. And one of the things that kind of drives me as an investor, and it drives sort of our mission of MicroCap Club, is really what annoys me to no end is just kind of the negative misperception on microcaps.
I was going to say, where do you think that comes from?
I don't know if it's just the mainstream financial media. I don't know if it's what it is, but I mean, the regulations aren't helping. I mean, I know today, I think Merrill Lynch just said that you can't even trade a stock less than $5 per share. And so it's just getting harder and harder to even access to a brokerage account to even buy these small microcap companies. And it's a shame. I mean, when you look at the historical perspective of microcap investing, I mean, most of the best investors ever started as microcap investors. I mean, Buffett started as one. I mean, Berkshire Hathaway, even on an inflation-adjusted basis, would have been considered a microcap company when he took it over. Peter Lynch was a microcap investor. Joel Greenblatt was. Some of the best performing companies ever started as microcap companies. Walmart, Netflix, Amgen, Celgene, even Berkshire Hathaway, like I mentioned. You can go down the line. And the majority of public companies that even in the last 5-6 years that have ascended more than 1,000% or more. So in the last 5 years, those companies that have gone up 10x or more, I think around 80% of those companies originated out of the microcap ecosystem. And so when you think about that, this is a vetted investment class. The best investors ever invested here. That's where they got their start before they got too successful that they grew out of the space. Some of the best performing companies ever originated out of this space. And some of the best performing companies in the last 5 years originated out of this space. And yet, we fight this battle in the mainstream media or financial media and elsewhere that, wants to depict microcap investing as just some slimy, sleazy cesspool.
Maybe it's because it doesn't sell. It doesn't sell. It's not like sexy. It doesn't sell a lot of clicks and stuff along those lines.
Yeah, I mean, I think it's interesting. I mean, when you think about microcap investing as an investment class compared to venture capital, compared to private equity, I mean, there's a lot of similarities there, and you could say that at least on the microcap side, there's a lot of transparency. I mean, most of these companies, or a lot of them, file audited financials, and it's so there's transparency there, and there's a decent amount of companies, and yet, the financial media loves venture capital, and they love private equity, but they hate microcap investing, and it's something that just doesn't make any sense. So one of our main goals as an organizational MicroCap Club is just kind of bring respect and credibility to the space, over the long term. And, it's a big thing that drives us as an organization over there. And it's unfortunate, I don't want to just say all the positive, unfortunately, a lot of people's first entree into the microcap ecosystem is some hard mailer they received in their mailbox, touting some slimy penny stock, and they invest in it, they lose their money, and they never want to look at it again. And unfortunately, that still occurs. But there's definitely a lot of good companies that exist down in the microcap ecosystem. So I didn't mean to hog the podcast, but that's kind of gives you a little.
No, that's great. And do you almost feel like microcaps, I guess, for example, like with the S&P 500 being, close to an all-time high. I know the past the past couple of weeks have been incredibly volatile, but do you almost feel like there's an inherent hedge in that asset class because the stocks tend to act more on their own performance metrics and then their own 2 feet? I've met with a ton of people who they'll say, I could tell how my portfolio is doing just by looking at the S&P 500 every day, and if it's up, I'm up, and if it's down, it's down. Like, to me, I feel like that's not really investing. So I feel like microcaps are great because it's truly stock picking. And that's sort of how Geoff and I sort of think about it.
Oh, exactly. No, I think you hit the nail on the head. And I think one of the reasons why there's that big difference between the historical performance of illiquid microcaps compared to liquid microcaps is because those liquid microcaps are institutionally held. And one of the reasons why I like to stay away from liquid microcaps specifically is because a lot of those companies, and most of those companies would be in that upper half of the microcap ecosystem. So, 150 million to 300 million market cap. A lot of these microcaps are institutionally held. They're already kind of indexed into the Russell microcap indices. And oftentimes when we have little bumps in the road in the economy, or you have some bad data that comes out, or a couple quarters of bad GDP, or whatever the case may be, institutional investors, family offices, what have you, want to take risk off. And the first place they go to take risk off is somewhere like microcap exposure. And so they immediately call up the funds they're invested in, or they track down the indice they're invested in that gave them exposure to microcaps, and they try to take that exposure off. And that puts kind of an inherent constant bid pressure of selling on those liquid microcap equities when, the macro economy gets a little shaky, and especially in a bear market. And the interesting thing is when you're in illiquid microcaps that aren't institutionally owned, those institutions can't sell what they don't own. And one of the investments that I was in during the 2008-9 time period, even though the S&P got slaughtered, down 55% or whatever it was to trough, was a small microcap company that wasn't owned by any institutions. It was illiquid, but it kept on growing, and it kept on earning more money, and it went up 287% during that time period. And what is interesting is when you can find these companies, and they're hard to find, we can get into that later, but when you find these companies, even during a bear market, institutions are attracted to things that they don't own that are fast growing and make money.
Sure.
So that's what occurred in an equity like that.
Yeah.
So I primarily focus on really that bottom half of the microcap ecosystem, because I think that the historical returns in the liquid microcaps are negatively impacted by by institutions owning the microcaps and then coming out of them when the economy starts to turn for the worse.
Yeah, that's definitely interesting. What do you think separates, I guess, the bad microcaps from the good or the great ones?
Management team.
Yeah.
Management team. It's what it comes down to. I think the smaller you invest, like the smaller the company that you look at, the more important the management team becomes. And I think I kind of visualize the management team as, they're the head or brain, and the product or service is the body. So I kind of picture a human body. The management's the head, the product or service is the body. And you can think about it in your own life. How many extremely gifted people have you known that, either intellectually or physically, that never really lived up to their full potential because of bad decision making? All of those gifts, talents they had just wasted. Similarly, I think when you look at microcap companies, it doesn't matter how great a company's product or service is if the management team doesn't make the right decisions, because these are small companies, they're impressionable, and ultimately what it comes down to is if the head is deaf, dumb, and blind, the body is useless. And I think that's the same type of analogy you can use with these smaller microcap companies. And these smaller companies, they are a small business. And so these management teams, they wear a lot of hats. They're not just the CEO. They're the, chief bottle washer and, everything.
Yeah, sure.
Included.
Yeah, you're buying the entrepreneur for sure.
Yeah. And so you got to make sure you're betting on the right jockey. And, it's sort of one of the reasons why I got so interested in then studying Intelligent Fanatics, which started a couple years ago, is just trying to fine tune my qualitative lens for finding great leaders, because ultimately if you're a microcap investor, you want to find great companies early, and to find great companies early, you need to find great leaders early. And so that's primarily why I try to continue to fine tune my qualitative lens for investing and finding those right leaders. And intelligent fanatics, when you're trying to find a great leader, which is what intelligent fanatic is, it doesn't mean you're trying to find somebody that can do all of those things better than anybody else. You're actually trying to find somebody that can scale a business and delegate and find people that they can inspire and get the most out of them. Because ultimately, even some of the success stories in the microcap ecosystem, they reach a ceiling. And that ceiling, and I think Brent Beshore talks about it quite a bit for those that follow him, the ceiling, and that could be them taking the company from 0 to 10 or 20 million, but that ceiling is ultimately reached because they can't do everything anymore and continue to scale that business. And so a lot of my due diligence that I try to do, or maintenance due diligence on positions, is kind of evaluating not only the founder, but the people that are right underneath him executing that strategy. Is this a business that truly can scale past the ability of the CEO or founder himself or herself?
That's interesting. So Artco Capital, Peter Rabover, he came on the podcast a couple weeks ago, and he was talking about, because he's a microcap investor, and he was talking about, certain managers and what makes, I guess, the good from the great, and certain things that we like to see, in management. And he was talking about how he understands in the microcap space how a lot of these managers, they're in the point of their career where they're trying to get rich. They may not be, completely wealthy. What are your thoughts on, skin in the game when it comes to management? Like, for example, Peter was saying that he understands that, they may not own 20% of the company, or they may not have, their entire net worth in this business, because they're a lot like, I guess, normal people that are trying to become wealthy. What are your thoughts, I guess, on how management is compensated?
I think that he's right. I mean, I think incentives, management compensation is important. Ultimately, you want to find a CEO that owns a nice chunk of the business, that gets paid a low salary or a below average salary, that has skin in the game, that is also frugal, which some of these things, a couple of those things you can pick up on filings. The other couple things you have to pick up on by doing scuttlebutt research and on the ground research. But I found a lot of times it's these qualitative nuggets that you pick up on that dictate, if you can come to a conclusion that this is somebody that can adequately scale this business past his or her ability. And it's funny when you look at the microcap ecosystem as a whole, you're going to run into a lot of bad companies, a lot of bad operators, obviously, just like you would in the venture capital world. I mean, how many of those companies fail? I don't know what percentage, but I would imagine it's probably a bigger percentage of failure than in the microcap ecosystem. But you're still dealing with the same issues. And so oftentimes when you run into microcap companies, you have kind of some negative attributes that you're looking to stay away from. And, I ultimately like to invest in management teams that have skin in the game, that are frugal, that are properly incentivized. And, it's the tough thing is you can find some examples of some companies that did well, that maybe the CEO did get paid an above average salary, but they still performed. And so none of these things are, it has to be this. But I think it comes back to, for me as an investor, I'm trying to find situations that I can gain conviction in and that I can see through to the end. It's hard for me to do a lot of work into something. Will I be able to have the conviction knowing that the CEO is overly compensated? That, maybe he is running the business because of his, $300,000 a year salary, when the business does $5 million in revenue. I don't know. And so you just want to have that proper alignment. And I think it's really important, not only in microcaps, but any type of investment that you're making.
Yeah, I completely agree. So I sort of want to shift gears and talk about your actual investing process when it comes to structuring your portfolio. So I'm a big process guy, and I'm always interested to hear about other people's process. Like if I ever reach out to someone via email, typically the question I ask is, what's your investing process? So how do you sort of structure your portfolio? Are you long only? Are you concentrated? How do you sort of go about structuring that?
So I'm probably like Geoff, where I'm fairly concentrated. I would say I'm in 5, 6, 7, 8 positions at any given time.
Sure, yeah, that's very concentrated.
And it's purely a microcap portfolio. I don't have small caps, mid caps, large caps in the portfolio. It's strictly microcap. And so, now some of those companies, if I'm doing it right, I'm not making very many decisions. It's like I probably find one new idea a year, if that, and maybe that's part and parcel because of the economy where we're at, where there's, less opportunities to look at. But, ultimately I'm trying to stay in these companies as long as the management teams execute. And so I've always been a fairly concentrated investor. It doesn't mean my way is the right way for anybody else. And ultimately, I don't know if it really matters whether it's 6 companies or 10 or 15. But for me, I've always been very comfortable owning towards the lower end of that scale of 6, 7 companies, and having a big chunk of that, of probably 50% of that portfolio in maybe 2 companies. One of the things that early on in my investment career I used to do was, when I found something, I would really just pile into it. I would go almost all in when I found something. And the problem with that, or the good thing is, when it works big, and you do really well. But the bad thing is, it's only a matter of time till something disappoints you and you wish you wouldn't have piled in all at once. And the great thing about microcap investing is that these are small emerging companies. And what I tend to do differently now than I did back then was I take smaller positions initially and wait for management execution to be the deciding factor if I should add to that position. And I have no issues averaging up into a position that is executing. And I think that's probably a big hurdle that some investors might have. It's a hurdle that I used to have as well. But when you think about it, a lot of the biggest wins you're going to have, they'll go up for years, and if not decades, hopefully. And so, there's no problem with buying a smaller position and then waiting to see some execution to then add to that position as it goes, and hopefully you're averaging up.
Yeah, that's great. And how do you go about finding these types of companies? Because, there are so many microcaps. What's sort of your process like when it comes to searching for them? Do you use screens, or how does that happen?
I'm not a big fan of screens. I find that when you do a screen, you're finding companies that everybody else is finding. And so, for example, when you look at the smaller microcap segment, there's probably around 8,000 microcaps that are sub 120 million, let's say 130 million. And if you were to do a screen on those companies, let's say you would just do a screen for a growth rate, an earnings rate, book value, whatever you want to do, it's very easy to get that list of 8,000 companies down to 30. It's actually kind of scary because it shows you how small the ecosystem is as well when you do that. And the problem with that is that everybody else is doing those screens, and you're finding everything that everybody else is finding. And what I've found through the years, and what I've done really since the beginning, is I'm trying to find these companies before the inflection point, before it's obvious in the financials. And so for me, that means that I'm looking when they're a little bit younger, when they might not start showing up on these screens that most other investors do. And I think a lot of people might think that's risky. It's interesting when you look at the Russell Microcap Index today, I think 47% of the companies are unprofitable. And I think a lot of people would think about that 47% and think that I do not want to look at at those companies because those are risky. And a lot of them are. But I guarantee that there's some companies in that 47% that are about to hit that inflection point of profitability, and it's going to take somebody that's willing to dig below the surface of a screen to find them.
Yeah, I agree.
And so I use a myriad of tools, which I'm sure you and Geoff also use, which I don't think I've ever found something in a screen, by the way. But it's one of the reasons why MicroCap Club was created. So MicroCap Club's great, and it's obviously a plug for MicroCap Club, but it really is a great resource to find ideas. That's why it was created, and that's why it exists today in the MicroCap ecosystem. But it's also word of mouth. We all have maybe a dozen or 24 friends that are kind of like-minded that we're always sharing ideas with privately. It can come from message boards, public and private. It can just be from looking at news, PR, SEC filings, serendipity.
Sure, yeah.
But it's a lot of different ways. It's a lot of hard work. But primarily it's through a bunch of those different areas. And ultimately I'm looking for things that are misunderstood, that the market or investors aren't paying attention to for any given time. Like, I'm not a big fan I haven't been a big fan of the term even value investing. I kind of like misunderstood investing. I'm looking for situations that are misunderstood by the marketplace. I talked to you a little bit about my one sentence investment strategy that I refine every year. And if I were to show you that one sentence investment strategy, which was, my goal is to own the smallest, most illiquid, least institutionally owned, misunderstood businesses I can find that are run by intelligent fanatics. A year ago, instead of misunderstood, I would have had highest quality businesses. And I've taken that out because I've realized that it's not entirely accurate. Because some of the things that you find might not be quote unquote a quality business. And quite honestly, I can't stand the word quality business anymore too, because I think it's the most overused phrase in value investing as well. So I'm really looking for misunderstood kind of opportunities. And to find those, you kind of have to look below the surface. And probably the simplest and truest form of this is probably deep value investing itself, where you're analyzing a balance sheet and you're not seeing the assets properly reflected on that balance sheet. That's misunderstood. Those assets that you're trying to find and evaluate on your own. But it can also be the management team might be misunderstood. The intellectual property might be misunderstood. The product or service or the potential is misunderstood. There's a whole slew of investors that just look for management changes in companies to take a position, because they know that as soon as a management change happens, there's a complete change in direction, and probably the shareholder base that has just been stuck in that stock for 10 years is so sick of it, they're just going to sell. And they've misunderstood the situation. And so there's a lot of people on the long side that just look for management changes as a way to take long positions. I think there's definitely different ways to characterize misunderstood, but I'm looking for those situations that it just takes some work to find. And really the main goal is to hopefully find situations that will be understood by the marketplace, that there are qualitative factors that are boiling below the surface of those financials do creep to the surface in the financials, in a reasonable time period that's attractive to you and or, your investors if you're managing outside capital.
Sure. And what are the type of companies that you look for? Like if you had to have a perfect business, maybe one that you already own, what does that business look like?
That's a good question.
You could take the price out of it, but just, I guess, the investment in general.
I would say that it's a company that dominates its niche, that's hard to kill, that when you do your scuttlebutt research, you find that there's a culture of excellence there, which probably some people's eyes are rolling, just me mentioning that, but I'll give you an example of what I mean by that. I think it's really important that not only the customers that are buying the product or service are really happy, but the employees are extremely happy to work there. And so one of the parts of my due diligence is actually trying to see what the culture of the company is like. And this could be a podcast on itself, but one of the best ways to find a company with a great culture is not to interview the CEO or the management team. It's going to the bottom of the company. And it's trying to find the lowest rung of employee and talk to them and see if they're happy to be there. And what I try to do and like to do is try to find 2 or 3 or 4 people that represent kind of that bottom rung of employee of the business that I'm evaluating, to get a sense of the culture that's in that organization. And when you find people that are on the bottom rung getting paid the least in the entire organization and they're happy to be there, you know that they're doing something right at the top. and so it's one of those kind of qualitative factors that I look for. But I would say culture is important. It's funny when I think about my portfolio today, it's over a diverse set of industries. And I would say some would be characterized, I would say, as a quality business, and other ones are just kind of misunderstood situations that I believe that the assets, the IP, or the potential of it, people just don't quite understand yet, and there's a risk-reward profile there that make the situation very interesting at the current valuation. So it's really a mix in my portfolio today.
That's awesome. I kind of want to shift gears. So you just a couple weeks ago, you had your summit, your MicroCap Club summit in Chicago. Is that correct?
Yes.
How'd that go? And maybe you could tell us about how next year's going to go. I was looking I saw on Twitter that you have the dream team lined up for next year's summit. Looks like you had Jim O'Shaughnessy, Brent Beshore, which also I want to talk about him in a second as well, and a few other individuals that I think a lot of people are going to love. But how did the summit come about, and typically what do you guys do at the summit?
So the summit came about with sort of an overall mission of wanting to bring credibility and respect to the microcap ecosystem, combined with wanting to have an event that brings our community together at least once a year. And so the event can be attended by our members and subscribers. And so it's a small event by design. Like, for example, our max capacity is probably 110, 120 attendees for the event, and which is nice. I mean, the investors enjoy it, the participants enjoy it, because it's a very close, intimate, type of setting. And so it's a 2-day event. So the first day we have speakers that kind of run through the morning into the early afternoon. And then the afternoon of the first day, we have our highest ranked members on MicroCap Club kind of give a 10-minute pitch on the favorite microcap that they like at the current market price. So we usually have about 10 of our highest ranked members. What that means is every member of MicroCap Club is ranked by the performance of the companies they profiled on MicroCap Club. And so you can go in there and see who the best member is based on their profile history of companies, which is a nice way to kind of get through the 200 members that are on there. So those people will pitch their favorite microcap stocks on the second half of day one. And then day two is we invite 16 companies, 15, 16, 17 microcap companies to come and present their stories to the investors that are there in kind of in a small group, almost like speed dating format. So if you can envision a big room with 16 tables, each company's at a table. Every 30 minutes, a group of 5 or 6 investors sits down. Every 30 minutes they move to the next one, to the next one.
That's awesome.
So it's a really great way to hear a lot of great stories. Also hear some good dialogue and questions from the people that are in your group, as you move around from table to table. People tend to just really enjoy it. We try to kind of, we've been to a lot of events, a lot of conferences, and try to have a mix of things over the 2 days that kind of scratches the itch of anybody that would ever want to attend, where you want to be enlightened, you want to learn something, which is from our speakers. You want to hear what some of the best investors in the microcap ecosystem like, which is the pitch session, and you want to hear some great stories from some companies that you may have never heard of before, which is our day 2.
That is awesome. And can anyone join that?
Yeah, I mean, as long as you're a MicroCap Club member or subscriber, you can then register to attend.
That is great. And yeah, so Brent Beshore, he's going to be there. And I thought that was pretty interesting. But the more I thought about it, I mean, so he's in the private equity space of, if I'm correct on this, of, I guess, technically microcap companies in the private space, right? And I was thinking, I'm like, a lot of the companies that he invests in are probably very similar to a lot of the companies that you and that Geoff and that I look at. They're founder ran, right? They're probably focused on 1 or 2 business lines. They're probably simple. So there's a lot of commonalities there between what he can bring and then I guess from like what the type of companies that we invest in.
No, exactly. Brent is amazing. And he presented our event 2 years ago as well. So he's coming back, which I'm honored he is. Morgan Housel, he's going to be there again, which is awesome. Jim O'Shaughnessy, like you mentioned, Sarat Madan, who works for Markle now, and also Josh Tarasoff, which is kind of a legend of qualitative investing. He's going to be there as well. I'm honored he accepted to come and present to us. But Brent does. I mean, there's definitely some overlap between what Brent does and he's basically investing. He's the lowest rung of kind of private equity capital looking at companies, meaning that he's looking at small companies. And I think maybe the profile has gotten a little bit larger now that he's raised some funds, but Brent's primarily looking for companies that have between $2 and $14 million in owner earnings.
Sure.
So that's definitely would probably fit most our public microcap ecosystem. And the wisdom that he has gained over the years by kind of evaluating founders, evaluating businesses, is just a wealth of information. And Shane Parrish actually introduced me to Brent maybe 3 years ago. And Brent and I hit it off really well right away because we had this kind of common connection where, his companies were private, the companies I invest in are public. In a lot of ways, I'm jealous of him because the companies he's finding and ultimately invests in, are trading at 2-3 times earnings.
Sure, yeah, he's talking about that.
The ones are not trading at 2 or 3 times earnings, at least not in this market.
So inefficient, that space.
Yeah, but he's really, really good at what he does, and I'm a firm believer. And so what's interesting is when you look at our speaker lineup as an example, I don't know. Let's see. When I'm thinking about it, I think there's only one investor on our speaker lineup that's actually would be characterized as a microcap investor, and that would probably be Jim O'Shaughnessy, because they have a microcap strategy, and he's a big fan of microcaps. But none of these other speakers are microcap investors. And it sometimes surprises people that our speaker lineup, it's not me presenting and a couple other good microcap investors, or perceived to be good microcap investors, presenting about their ideas and things like that. Because what I've found is, I think some of the best lessons and learnings you can learn come from investors or thought leaders that invest outside your realm of investing. And some of the best nuggets I've picked up on are from people that don't invest like me. And I think it's unfortunate, and there's that a lot of investors, they believe that I can't learn something from Andrew and Geoff because they don't invest like I do. And that's just, I think there's that mental block or roadblock that people have. And so they would rather read the 30-second book on Warren Buffett than dive into, Pat Sheridan, who is, a mining legend. How did he, invest in mining and become, a billionaire through investing in a commodity-based mine industry? But you can learn these valuable lessons, some great nuggets, by evaluating people that and analyzing investors that invest differently than you, that are successful. So, we try to have kind of a mix of investors that, provide some different insights into the realm of investing. And that's what we try to bring on as speakers to our event as well.
That is awesome. So I sort of want to bring this to an end here soon. And one of the last questions that I always love to ask the individuals that come on the podcast is, how do you think individual investors and everybody listening can improve as investors?
I would say the way to improve as an investor is to invest. I had a conversation the other day about people that paper trade or paper invest, or the edge that you have in investing is usually one of emotions, which is kind of fascinating. 1,000 investors can be in the same kind of great company or stock, and their returns will be dramatically different. Finding a great company to invest in, it's probably not even half the battle. Price matters. Warren Buffett said price is his due diligence. Time frame matters. If you are going to sell the stock because it earned a penny less next quarter, that's going to influence kind of how you do. And your experience matters. Have you been through a bear market? And your temperament matters. If you see volatility in your stocks on a daily basis, will it force you to do stupid things? And so I would encourage people to learn investing by investing. And I think only through experience, you kind of weave your way and you find your way to a strategy that works for you. And, my way of investing isn't going to work for you. Geoff's way of investing and Andrew's way of investing isn't going to work for me or for other people maybe. And, people need to find their own kind of path and what works for them. The only way to do that is by going through the motions of investing and trying different things and reading about all the greats of investing. And then going out there, analyzing businesses or analyzing commodities, whatever your investing strategy is going to be, and then just start doing it. And fully know that you're going to take your lumps along the way, but those valuable lessons that you're going to learn just by experiencing investing is going to find you're going to find your way to your end point of what your strategy ultimately will be far quicker than if you're just too scared to take that first step. I know that's a very vague, weaving answer to your question.
No, I think it's great, and that's something that Geoff and I always talk about. It's actually investing, right? And when people ask us, how do I become a better investor? It's like, well, actually, start practicing investing. I feel like so many people, because it's such a I don't want to say broad industry, but there's just so much that I guess can go into it that a lot of people almost feel overwhelmed. And I fell into this bucket too. And maybe I'm just speaking for myself, where I read so many different books on investing for a while instead of actually just sort of getting, I guess, a good fundamental basis on investing and learning how to think about everything and then just practicing investing. And we see that with a lot of individuals is they just keep reading so many different books on theory and all sorts of things along those lines when really their time best spent would be just, reading a 10K, learning about all these different businesses and actually practicing investing.
Yes. No, I think I wrote a blog post on it maybe a couple of years ago, and I don't think many people read it because it was kind of a controversial title. But basically, the point of the article was the best way to learn investing is by concentrating into a few investments early in your investment career and kind of learning those lessons faster. And that's just not, and I don't mean to be reckless with a statement like that, but I do think that my maturation as an investor got shortened because I was concentrating on a few investments early in my investment career where the successes and the troughs were amplified because I was concentrated in a few investments. It doesn't mean you're taking just reckless risk, but I'm just saying, you just need almost all the successful investors we know today are successful because they concentrated earlier in their careers and they had a big win. It doesn't matter if they now say that they should be in 100 positions in their portfolio. Almost all investors concentrated early on, taking sizable positions and then just learning from those experiences and letting that experience compound as well as their capital.
Yeah, no, I completely agree. I always say that wealth is built in concentration and the wealth stays by diversification. I guess like to get rich, you need to concentrate.
Yes, right.
Yeah, I completely agree. Cool, man. Well, I want to thank you so much for coming on the podcast. I think this was great, and I think a lot of people are going to get something out of it. And like I said, this is a podcast that I've been waiting for a very long time and have been very excited about. For everyone listening, go to Ian's Twitter. One of my favorite posts that he has written is the tweet that is pinned to his Twitter. And it's titled, "There's no reason you can't make 10, 20, 50 million or more starting with a very small amount of capital." And I want to close this podcast with a closing remark that Ian had on that post. And he says, "Your investment philosophy will be shaped by your experiences. You have to create your own path, your own success story. I'm just here to tell you everything that you dream is possible. Now get started." And I think that's a great quote for a lot of people listening. Just get started. And when we were just talking about how to become a better investor, just get started. Ian, I can't thank you enough for coming on the show.
Hey, thank you, Andrew. And like I said before, I've been following you and Geoff, and I'm honored that you asked me on. Thank you.
Thanks so much. Well, everybody else, thank you so much for listening. If you do like this podcast, please feel free to give us a rating review. That definitely does help out Geoff and myself. It sort of spreads the word with us on iTunes. Other than that, we will see you next Wednesday. Everybody have a great week. Take care.